Hi everyone. This is Tyler Steinhoff from Insurance Advisors Direct here with Mike from NGL. We're going to discuss the long-term care partnership program and how that exactly works. So, Mike, first off, we're talking about what is a partnership plan. What does that mean when you say the NGL's partnership with Medicaid?
Sure, absolutely. So what that means is that the traditional long-term care policy is supercharged, meaning you receive extra asset protection at the back end of a claim. So in summary, if you were to deplete your long-term care policy, and you're still alive after that policy has been depleted, and you still need care, well, then at that point, you can legitimately apply for Medicaid and legally protect from your state's Medicaid spend down requirements a like amount that the long-term care carrier paid out in claims. So, quick example, I need long-term care services, and I receive home health care, and then let's say subsequently go into a nursing facility, and I used up $500,000 in long-term care benefits. However, I'm still alive. I've depleted my long-term care policy. I'm still alive, still need care. At that point in time, because my policy has that partnership addendum to it, I can then legally protect from Medicaid spend down requirements $500,000 in that example. So the reason why that's important is because twofold. The states want to give extra incentive for people to plan on their own, and this is their way to do it by providing. That's why they call it a partnership plan. For example, the Michigan Department of Medicaid is allowing that extra Medicaid allowance protection because you had a long-term care policy.
Gotcha. Yeah, that makes sense. So, in essence, if you were to have a policy and it started at $250,000, and we had an inflation rider on there compounded to, for example's sake, we'll say $350,000. If you were to exhaust $350,000 and you still needed care, that would be exempt in your assets. That would be your home, car, everything else from Medicaid spend down.
That is correct.
Yes. And then you also mentioned the state planners. I'm glad you mentioned that with things that have happened, and they're happening now in New York, what we've seen in Washington. How do you think this is a good solution to solving that potential future for the rest of the country? And how that's going as far as the tax laws that are looking to be implemented on folks who don't have a long-term care plan.
Absolutely. And as you said, there are several states that are looking in the beginning stages of putting together some sort of publicly run plan in which working residents of those states would be taxed for a public statewide long-term care program. And I would say now this is not certain because a lot of these states are still in the infancy, but we have the state of Washington to use kind of as a guinea pig, and that's what most states are looking to do. So if I had to bet, it would be more likely than not that people that have a long-term care policy, especially a policy that is partnership certified, would probably most likely be exempt from those taxes. So that would, and I believe, states that do eventually implement such a public program, I would believe that would be the case, that, if I were to show the state, look, I have my own private traditional long-term care policy, and it's partnership certified to boot, well, that would most likely, we don't know for sure, but most likely make you exempt from any taxes.
Yes, and that makes sense. And now, as far as language and how to speak with the partnership spec clients, I
Mhm.
have had some of our agent partners ask me how to speak on this at a meeting. When this topic comes up, what is some good digestible language they can use to speak to a client and explain this clearly?
Sure. And you make a good point because, first of all, just making them aware that this exists is a big deal. Most agents and advisors I work with don't even forget to even mention this. With that caveat, I should say that there is a plan design requirement that the policy must have at least 3% compound inflation, automatic inflation increases for it to be partnership eligible. But I will tell you the vast majority of plans have that included anyway. But it's important to mention that because that is part of it. And then furthermore, I basically, and people love to hear when a product or a concept is endorsed by their state, whether it's a state or something they believe in. So that's how I think it reinforces the credibility of the entire plan. So what I think makes sense is to tell them that, hey, the state of Michigan, for example, really, they're really incentivizing people to do their own long-term care planning, because in this great state of America that we're in, we really are on our own when it comes to long-term care planning. So normally, the only fallback, the only state-run long-term care program we have is Medicaid, and normally the copay for Medicaid is everything. Is normally 100% to qualify for Medicaid, because literally you have to spend down virtually all your assets. Maybe we'll call it 98%. However, the state of Michigan wants to incentivize you to do your own long-term care planning. Thus, they are willing to make your copay a lot less if you have at least some long-term care coverage on your own. And it doesn't have to be 5 years, $300 a day coverage. It can be as low as 2 years, $100 a day, 2 years, $150 a day. And of course, having the inflation on there is important, but they're giving you more risk protection on their end, because you went ahead and planned on your own. So and I do think the spirit of these partnership programs are, hey, we will go with you. We will go, almost in business with you, and give you extra Medicaid asset protection on the back end, even if you have a small long-term care policy. So that's why I like to call it, the state is willing to supercharge your long-term care coverage. And most people don't know anything about it. Most people don't know much about it, and it makes sense to talk about, without a doubt.
Yeah, I think so. It's a huge point. And then that answers the question of if there's a limit on the benefits outside that. It's just the inflation rider that is required,
Right.
3%. So one of NGL's really big and cool features is that they have that shared benefit pool with spouses. How does that play into effect with the partnership plan?
Right, exactly.
Potentially, as the husband, I could have, let's say, for example, 300,000 and my policy, my end of the book. But between myself and my wife, we could have another 3,000 extra.
Right.
Does that qualify in addition?
Yes, it does. So our third pool of money concept, which provides more benefit dollars for a couple, it would any claims taken from that third pool does qualify for that Medicaid asset protection. So essentially, how it works is that at the time let's say I have a 2-year plan, my wife has her 2-year plan, and we have that third 2-year plan. If I were to use up my own 2-year plan and then use up the entire third pool of money, another 2 years, so 4 years of care altogether, and I'm still alive and I still need care, well, the good news is my wife keeps her 2-year plan. All right. Then at that point, the insurance company is going to provide the state Medicaid program with a certification, essentially a letter, saying that I depleted all my benefits and I used up this exact amount in claims dollars. So let's say each 2-year plan is $300,000, right? Equated to benefit dollars. So that would be $600,000 in total claims I used. Then at that point, Medicaid, the insurance carrier is going to notify the state insurance department that here we go. This person qualifies for an extra $600,000 in Medicaid asset protection.
Gotcha. That's awesome. That's a cool feature. And then the last question I have, which might be a little bit off what we're talking about, is there is, from what I understand, a way of age brackets for writing off the premiums as tax deductible.
Yes.
I have heard mixed reviews on if that is difficult and if it's not, and I've never heard an honest opinion from someone who's actually done it or a carrier. So what I'd like to hear from you is how does that work exactly? I know that there's age brackets going on and you can write off the premium on your taxes, but kind of what's a little more detail on that?
Sure. I'm glad you asked that question. So for clients that pay for their long-term care insurance through their business, right? So for your clients that have own a business, and if the business pays for their premiums and the premiums of a dependent spouse, then there are age-based limits that are actually pretty generous, that in which you can the business can deduct those premiums, right? So they change every year. In fact, they recently changed for 2024. Of course, I can provide all of you with our latest 2024 long-term care tax guide. But starting at age 51, in fact, I think between age 51 and 65, I don't have it memorized, but I think the deduction, the maximum per person, is about $1,700, which is significant per person. The key is it has, and this is where the IRS code is specific. It has to go through that business. The business gets the tax deduction. If someone is not a business owner, they don't own a business, it does not go through their business, then IRS code states that as long as they meet that 7.5% threshold, meaning they have to itemize their tax deductions and show that 7.5% of their gross income goes to healthcare expenses. Then if you meet that threshold, then non-business owners can deduct up to those age-based limits from their personal taxes. So that's IRS code, right? That's what it states, and what most insurance carriers have interpreted from IRS code. Now, with that said, all clients should always consult with their tax advisor as to, can they, can they deduct it? Can they not? But based on IRS code and how carriers have interpreted that, that's how it works.
Gotcha. And a little bit more on the code. Does it specify what type of business entity it needs to be? Could it be a sole proprietorship or just a type of business? Is there any restrictions that it states clearly?
It is very so. Yes, it can be a sole proprietorship. It can be an LLC. It can be a C corp. It's very liberal in that. In fact, I know of people. For example, a gentleman I heard about a couple of weeks ago. He has a side business giving guitar lessons, and he's paying his long-term care insurance through that, and he receives the tax deduction. So, so it's very liberal as far as what type of business can qualify.
Yeah, that's awesome. That's awesome. That's very flexible. I mean, I think for now, that's the questions that we have. I think that, yeah, that's a good broad explanation of the partnership plan, then a little bit off on the write-offs and what's code for IRS. And again, you're right. Always have the client consult their tax professional going forward. But that was a good example with the side business with the guitar guy with lessons. So, yeah, I mean, thanks for coming on here, Mike. And then any questions that folks have that watch this video, please feel free to reach out to me at Tyler at Insurance Advisors Direct. And if I can't get the answer for you, I promise you Mike can. So if we're working together on this going forward for the rest of the year, and we're looking forward to expanding this business of long-term care with National Guardian Life. So thanks, Mike.
My pleasure, Tyler. Take care.
You too. Thanks.
All right, thanks. Bye-bye.